Hi guys and welcome to today's YouTube video. In today's video we are going to discuss how to find the perfect stop loss for both your long and short positions while trading crypto. I see so many people asking me day in day out, Guru, where should I place my stop loss? And there is one thing that everyone should know before we start this video. There is not a perfect place for your stop loss. A perfect place for your stop loss doesn't exist. A stop loss is needed because you have a certain invalidation for your trade. Now, there are a few things that you can do to make sure that your stop loss doesn't get hit over and over again before the price reverses back up or down. Let's say you are in a short position and you put your stop over here. Often people get stopped out and then the price reverses back to their take profit target. What does this tell you? If this happens to you a lot, you are basically the liquidity for the market makers. What do I mean by that? I mean that the market makers are always targeting liquidity, or they're always targeting stop losses of the retail trader in order to fill their own orders. Their orders are so big that they need massive amounts of liquidity to fill them, so they will target the liquidity pools, fill their orders within those liquidity pools using your stop losses, and then reverse the price to make some profits towards the next liquidity pool. So, in order to find the right place for your stop loss, it is extremely important to find the area where the most amount of liquidity is, because that's usually where the price is attracted to. And in order to find the area where the most amount of liquidity is, you need to identify where retail traders are putting their stop losses. And finding where retail traders or even the regular trader are putting their stop losses is not that easy. It's not as simple as just picking a certain high and picking a certain low and saying this is my buy side liquidity and this is my sell side liquidity. No, you have to get into the mind of the retail trader and you have to figure out where people will jump into longs, where those will obviously put their stops, where people jump into shorts, and where those people will obviously put their stops. Now, in today's video, I'm going to explain to you guys, and I'm going to give you guys a few examples with the current price action on Bitcoin, where in this instance, the most amount of liquidity is laying. Okay, so in this instance, these are the areas where we do not want to put our stop loss, because in my opinion, these are the areas where retail traders will put their stops, so where market makers and the whales will enter their positions. Now, to identify where the stop losses are, you have to go back into time, because positions are being opened and closed all the time. So that means that stop losses are getting into the market all the time as well. Let's take this area for example. People that were longing the price of Bitcoin over here, right? Why would the people long the price of Bitcoin over there? They would long the price because they think that they see a valid break of structure over here. So they think we are going to get that move to the upside. They are opening long positions. Now, where are those people going to put their stops? They're obviously going to put their stops below the low over here. But they don't realize that this is not a valid break of structure because we haven't taken out any important high time frame liquidity pool yet. In this instance, the high time frame liquidity pool wasn't below these lows. Why wasn't the high time frame liquidity pool and the biggest liquidity pool contained with the stop losses of the retail traders not below these lows? Because it was way too close. Okay, the target of the retail traders in this instance was this high. Let's say they open a long position at the price over here. They can easily put their stop below this low, target this high, and still have a massive RR. Some would even put it below the low over here, which I'm marking out right now. And the RR is still there, so they can afford it to put their stops a little lower. In their head, they think I'm a really, really smart person. I'm not going to put my stop below these lows. I'm going to put my stop below this low. This was the sell-side liquidity in this instance, this low over here. Now, we didn't sweep it, we got a fake break of structure because of it, and by getting the break of structure, the liquidity was building up even more, because even more people were going to long and were going to put their stop exactly at the same spot, building up a lot of liquidity, which could provide a nice entry point for the market maker. So they push the price down to the liquidity pool, take the stop losses of the retail trader before reversing the price back up and taking the stop losses of the shorts. Now, why were the shorts putting their stops over here? Let's go back in time once again. We see move to the downside. We see another move to the downside. Now, in this instance, with this second move to the downside, we see not a break of structure, right? Because we're not closing candles below. But the retail traders think that we see a break of structure. So what will retail traders do? They will start longing the pullback, or they will start market shorting over here. Now, the people that were shorting over here and over here, where do you think that those people were putting their stops? And where do you think, more importantly, where they were putting their take profit target? Obviously, their stops were above this high, or they were above this high over here, right? Some might have put it above this high, but most of them were at least resting above these highs. Their take profit target is very obvious. They were all targeting this low. Now, the fact that their take profit target didn't get hit means that their stop losses are still here. Because let's say that their take profit target gets hit, that means that their position will be closed and their stop losses will be gone. Or they have tightened their stops to break even, which means it's not that interesting anymore for market makers because they won't wreck those people anymore. So sweep the liquidity, target the next liquidity above these highs. Lots of retail traders wrecked. Okay, now after the move to the upside, we get this swift move down and we are seeing this slow grind back up. Where are all of these people putting their stops? They're putting their stops above this high, right? They're not going to put their stops above this high. You want to know why? Because they think they're going to outsmart the people. They think, let me be smart, I am going to put my stop above this high, because if I short it over here and put my stop above this high and target this low, I still have an RR of 2.17. So I can afford myself to put it above this high and still have a good RR. So most of the liquidity currently resting above this high. Why is that a nice confluence? Because above that high, we have an untapped supply area. So we front run that supply area, might be an inducement before we actually sweep into the supply. This could be a potential short. Why could this be a potential short? Because we are going to enter where people are going to get stopped out of their position. So we are going to enter where market makers are potentially going to enter their position. All right. Now, where is the most amount of liquidity laying to the downside? We can see that during this move to the downside, we put in these wicks over here, right? This was the low that we formed. After that low, we started grinding up. People were shorting this, targeting lower levels, but there are also people longing this move, targeting this high and this high, targeting higher levels, right? Now, where are all of these people going to put their stops? They're going to put their stops below this low, right? Don't forget that we have a huge liquidity buildup over here, constant higher lows being formed, but that doesn't necessarily mean that you have to take the lowest low. No, you have to get into the mind of the retail trader. You have to figure out where and when they were going to open longs. They were opening longs over here. They were opening longs targeting this high. Let's say they open a long over here, putting their stop all the way below this low, targeting this high. Look at this RR, only 1.25. It's not worth the RR. But let's say they tighten their stop below this low. Look at the RR, 2.3. That is worth it, right? So that means that the stops are resting below this low. Below this low is where we have an untapped order block with this red hammer candle in which this low might form the perfect inducement before a potential long position, targeting a higher liquidity over here. Now, if this high gets taken, you don't want to play this position anymore. If this low gets taken, you don't want to play this position that we were looking at over here anymore, because the draw on liquidity is gone, okay? So make sure to get into the mind of the retail trader every single time when you are determining your position, when you're determining your stop loss, because not only can you use it in order not to get stopped out yourself, but you can also use it in order to fill your own position and make sure to get filled where market makers are looking to get filled. And in order to do so, you have to analyze the previous price action, you have to analyze the behavior of people, and you have to analyze where you think that retail traders will put their stops. If you master all of this, I promise you, you will not only get stopped out way less, but you will also hit your take profit targets way more often. If you guys do have any questions after watching this YouTube video, please let me know in the comments down below. Also make sure to join our free Discord and I'll see you guys there. Thank you guys for watching and I'll speak to you guys soon. Ciao, ciao.